Hey, it's Soleil, and this is episode 150 of the Orange Pill Investor. I can't believe that I've recorded about 150 videos in about 160 days. Just took that week's vacation, and my goal is like 350 videos for the year, so I'm on track to hit that. I am going to take another vacation or two, so we'll see if I end up just coming close or if I have to do like 2 videos a day or something. At that point, I think the numbers probably won't exactly matter, but I just wanted to create a goal that made creating the videos like a habit, just a default activity, feel comfortable on camera, all that good stuff. And so that's working out. Eventually, I'll probably do less frequency and try to do some quality over quantity, like my heroes, the Quant Bros. But until then, you're stuck with quantity over quality. But I'm having fun with it. I hope somebody's getting some use out of it. But today I want to answer 2 questions. The first is, how much does an options education cost? And the second one is a question that I get fairly often on X and YouTube comments alike, like, why would you limit your upside in something like MicroStrategy when, as I fully expected to, in the next year and a half, I expected to go up like 5X, 10X. Crazy X values could be in the future for it. So let me just start off with answering the question of how much an option education costs. And so here's my Robinhood account, and they have a weird way of tracking your showing your account value, but I kind of like it. I don't have that available on Tasty Trader. I just haven't figured it out. But right now, I just have the 5,000 that I transferred over here for the 5K account challenge. I'm trying to pump this up to 25K as fast as possible. So, but if I look at all time here, this is a graph of everything that I've made or lost. I used to trade almost exclusively on Robinhood. And so you can see right here, like May 2020, is when I started trading, and it says and the reason I say it's kind of weird is like it says that my Robinhood account at this time had negative money, and that's because I've withdrawn more money than I put into Robinhood. So I made some money, I made more money than I put in, and then I took that money out and I moved it over to my Tasty Trade account. So Robinhood is kind of like saying, oh, back in May of 2020, you had negative 30 grand, but that's stupid. So it just means that I've withdrawn more than 30 grand more than I put in at that particular time. So it's doing some weird math. But anyway, that's not the point of this. The point is, everybody was making money at that time, and so I did kind of have it in the back of my mind, like, well, everybody's making money, but I'm making more than the SPY, so am I doing something right, or am I just getting lucky? And I'm selling covered calls the whole way here, except at some point, the guy who got me into options, when I showed him how I lost all this money here, he's like, oh, you're egg-heading it too much, because at some point, I realized that I could use my buying power more efficiently by doing poor man's covered calls instead of straight up covered calls owning 100 shares. It was easier on my buying power, and I was able to actually almost double my returns per week. Now, that was great in a bull market, but then, like right here, when I had tons and tons of long calls, so I had bought these in the money leaps that I was selling covered calls against, and right around here I had a whole shitload of these Tesla contracts. And when the Fed decided that they were not going to raise rates, but then they started raising rates, and the market tanked, and Tesla tanked hard. And I'll show you what a long option can look like. When the price is going down, it's devastating. It sucks when Tesla goes down from, what was it, 400 a share split adjusted to 100 a share. Okay, you're going to lose 75%. But if all of that is in long options, I would say you probably lost 95% of your account value. So I'm like, oh, okay, May 2020, let's go from negative 32 to 146 plus 32. So I had profited 178 grand, and really the real number here was about 70,000, I think, because I closed my IRA, and I think I took the COVID withdrawal or something, so I could take it out without a penalty. I realized that I felt like I could do better managing my own money, and so I took that 70 grand and I turned it into, what did I say, 170. Yeah, so the top here is 146. So yeah, another 70. So yeah, I turned it into like 210, 240, something like that. And so I'm like, holy crap, in 18 months I like tripled this account. And the funny thing is I had only put in, I don't know, like 30 grand, and then I'm trading with that, and then so it wasn't even like, I ended up like doubling it and tripling it in less than this time, because I didn't get the guts to take all that money out of my 401k. Once I was gaining more success, I started pouring more money into it. And so right about here, that's when I started eggheading it, and instead of selling covered calls, I have these poor man's covered calls on. And then over, so let's say November 2021, my account was at its peak, and then within 2 months, I gave all that money back to the casino. And 2022 was basically like a lost year. I kind of had to like dust myself off, and I think I might have been trading more on my Tasty Trade at this point. But you can just see this Robinhood account does almost nothing for a year, because I wasn't trading very much money on this account. And then at some point, I transferred some money here. I was doing different strategies on Robinhood and Tasty Trade, so I was just keeping those accounts separate. And then, of course, started gaining a little bit of money back here. And then I forget what this dip was, and then right here is where, somewhere along here, I start the 5K challenge, and then turned 5K into 3K. But then right now it's back up over 5K, so almost 10% up. So for me, an option education cost like $150,000 I lost. I made it and lost it. And so now poor man's covered calls are a very small part of my portfolio. So on my main account, the only thing that I'm selling poor man's covered calls on are these 2 contracts. So I got the 150 strike calls in March 2021, and they're worth about $5,000 a piece, almost. And the delta is not amazing. Was it like a 0.72 delta on these? These could absolutely get wrecked in the same way. If this Tesla vote goes the wrong way and Tesla drops 20%, these leaps will plummet in value. But this is, what? Let's see, 10 grand. if that was 10% of my portfolio, that would be on a 400. So this might be like 2.5% of my portfolio here. And if I lose it, it's not the end of the world. Now, of course, I have 400 shares of Tesla as well, and if Tesla takes a dump, then I'll get murdered on this one. But these leaps are a very small portion of my portfolio. However, in my IRA account, I used to own 100 shares of MicroStrategy. So this IRA account should be worth, should be worth 159,000, and it's not. It's probably worth under 100. And the reason is because, actually, it's probably worth barely over, all right, what are these 10 shares? That's 15. Yeah, like 85. This might be worth like 85 grand right now. Because I limited my upside in MicroStrategy, and these shares got called away. And so almost all of this IRA is a poor man's covered call. And I'm willing to take that risk in this account because it's an IRA. I don't need access to the money, so I don't need to withdraw anything from it. And if it gets decimated, I kind of just don't care. I basically am trading with the original retirement money that I had, that I took, that took that 70 grand out of my 401k to begin with. And so this is kind of like a long-term thing. 10, 15 years from now, maybe I'll need to access this money. So I really just don't care. This is fine. But in my main account, this level of risk is not, I wouldn't be able to stomach this. All right, so hopefully I'm going to be passing along some of the threats and the mistakes that I made. And really, it's not necessarily that I needed to avoid poor man's covered calls completely, but the position size. Because of my inexperience, I didn't realize that my position size was too large. If I had been in shares, then it would have been, these drawdowns are painful, but they're not. Let me just pull up Tesla. But they're not, they're not going to blow up your account. So if you own shares at 400 and it goes down over a period of, November, a year to 100, this is excruciating all the way down. You get these rallies where you're like, okay, I'm fine. Oh, no, I'm not fine. Oh, I'm fine. Oh, I'm not fine. So it's still an emotional roller coaster. But owning the shares is way more palatable than owning the options, because let's just do long call. Let's look at Tesla. Tesla. All right, so if I was selling, I am selling poor man's covered calls. Which ones do I have? What did I say? So 150 strikes in March. So that's almost a year away. So let's go to March 2025, and I got the 150 strikes, right? Calculate. If this shareholder vote goes to shit, my shares, or excuse me, my leaps that are worth about $5 grand right now, if the price drops 20%, what would that be? 17, 34, 35 bucks. But the price drops down to 140. Oh, it doesn't even go that low. All right, if the price drops to 150, Going to improvise, adapt, and overcome here. If the price drops to 150, that's about 20. What's the current price? 177. So $27 drops off the price. If you own the shares, you're going to lose $27 a share. However, my $5,000 leaps will lose like 40% of their value. So this is absolutely devastating. And let me just change the range to like 125. So we can really see the pain in full effect. So if Tesla drops 20% to 140-ish, right, then these leaps will drop in half. So that's why these things are so dangerous, and that's why the position size has to be managed properly. This has to be built into your risk tolerance. You know, not financial advice, of course. I've wondered if I should just go and become a financial advisor, so not to save me enough time to stop saying not financial advice over and over. But when the price is going up, it's amazing. It feels great. When you're in the green, this is awesome. Tesla goes up 10% to what, 195, then your option's going to go up by like a third. Well, no, that's 25%. So leverage is good when numbers go up, but leverage is absolutely painful when numbers go down. All right, so that's the two biggest lessons that I learned is leverage is dangerous, and so when you're sizing your positions, it has to be managed correctly. And if that's too much risk, then, you know, for the most part, I just own the shares. There's no it's actually a much safer trade than just buy and hold at that point, because you're reducing your cost basis. So for me, selling covered call, cash secured put, kind of a no-brainer. It's easy to learn. You just buy the shares, sell a covered call above your cost basis, or sell a cash secured put and bank the premium. Buy more shares and just keep going. And so this is how I let the profits snowball. I call it reaching critical mass. So if you only own 100 shares, and it doesn't matter how expensive or cheap the stock is, if you're collecting a percentage and then you use that percentage and you're just reinvesting 100% of the profits, then this works on a 5K account. You know, I'm doing this exact same strategy on my 5K account, trading Mara, Hut, and Riot, and I'm using fractional MicroStrategy shares as my store of value instead of holding cash. Or whether it's in an account where you're trading, you know, MicroStrategy and Tesla. It doesn't matter. You're collecting a percent of whatever the stock price is. So I put this spreadsheet together, and I'm like, okay, if I collect 1% premium in a week and I buy a share with it, then it's going to take me 100 weeks to get another 100 shares. And this is not putting any extra money in from my, you know, that I make from my 9 to 5. This is just starting out with 100 shares of stock. It's going to take me 100 weeks to get 200 shares. And this is like, you know, heaven and earth just moving perfectly, and the price staying constant. So this is all hypothetical, but this is kind of the way that I view it. Well, now I have 200 shares, and I can sell 2 covered calls a week, which means I can buy 2 shares a week, and it's only going to take me 50 weeks to get my another 100 shares, and now I have 300. Now I'm selling 3 covered calls a week and buying 3 shares a week, and it's only going to take me 34 weeks to get to the next 100. And hopefully you can see the pattern, and it's not a get-rich-quick scheme, that's for damn sure. But eventually, I call this reaching critical mass. So if you're only collecting 1% interest, but you have 10,000 shares of a stock, now you can buy 100 shares a week, and you don't have to wait at all. So you sold 100 covered calls this week, but now you can buy another 100 shares, and now you're selling 101 covered calls. And then next week you're going to sell 102 covered calls, and then the next week you're going to sell 103 covered calls. This is what I call critical mass. This is here you're just getting 1% a week, but here you're getting, this is basically turning into a compound interest generating strategy now. So 1% a week would be 52% a year. But the formula for compound interest is you take 1%, 1.01, you raise it to the 52nd power because there's 52 expiration days in a year. And now instead of making 52% returns, you're making 67% returns. And so this is what I came up with, and those returns are just if the stock price doesn't change. So if you're a buy and hold guy and you own shares, well, if the price doesn't change over this 11 years it took me to get to critical mass, you know, just buying a share a week or whatever. But if the price hasn't changed, now I have 10,000 shares of this stock, and whoever bought 100 shares still just has 100 of them. So this is why I limit my upside. When people are like, oh, why would you limit your upside, you know? Well, is the price of that stock going to go up 10x in 10 years? I hope so. But if it, like, I don't need it to. I don't need it to do a damn thing because I'm gonna go out and create value on my own. Thank you very much. So this is why I'm an active trader. And if you look at some of the things, it's like, oh, what's the best environment to trade a covered call? And it's like something that's not too volatile and doesn't go, you know, maybe doesn't go up that much. And while I'll agree, I probably wouldn't trade like pharmacological stocks because they're going to be like $10 a share, and then they're going to announce that they got FDA approval, and it's going to be 100 the next week. So yeah, I'm not going to collect little percentages when there's binary events that can happen to cause that to just go through the roof. Now Tesla's a bit like that too. I mean, when they announced full self-driving is perfected and they got customers that are buying it, Tesla's going to move. And so, yeah, I think about those things and I worry about them a little bit. But this strategy, so for me, this is the strategy that I like. But then once you've decided on a strategy, then you have to decide, well, which assets am I going to trade? And when I started out, I would just trade anything. I went to Market Chameleon. And even though I don't go to Market Chameleon much anymore, I always have this tab open. Like, I just can't bring myself to close it. I spend so much time on this damn thing. So I would go to Option Implied Volatility Rankings Report, and I'd sort by highest implied volatility, and then I would just spend hours going down and checking all of these tickers. Look at GameStop. Oh, God. So anything with high implied volatility, I would just sell covered calls against it, sell puts against it. I was basically just a premium hunter at that time. But I've settled on Bitcoin derivatives, and Tesla because I think they're disrupting and they're the clear winners in their environment. So for the long term, I'm bullish on those assets. And so if I've already decided that selling covered calls is the strategy that I am going to use, I still want to choose the the assets that I think will go up the most, because I'm collecting like 1% a week, but I'm also building in 10% of call-away value. Call-away value is the distance between the price of the stock and the strike that you select, and you are going to be able to gain 100% of the upside up until you get to that strike, and then only when your stock price breaches that strike, that's when you stop making money off of it. So even though I'm guaranteed the 1% in the commissions that I collected, I have like another extra 10% in potential value. So the price of Mara was 21 when I sold it, but if the price went to 23, I would collect all of that upside. So that's another reason why I flinch when people say, "Oh, you're sacrificing unlimited upside." I'm like, yeah, but 10% a week times 52 weeks is 520% a year. So I'm happy with capturing that potential. Now, of course, I realize that sometimes it goes up 1%, up 5%, up 10%, up, down 10%, down 3%. And then on some news, it might go up 40%, and I only capture 10 of that 40. Yes, I completely get that. But the whole time it's flat or down, I'm also banking 1%, 1%, 1%. And it all seems to average out in the end and to my benefit. So eventually I see this as my only source of income. And so, I don't really screw around with dividend stocks. So I need to generate a yield against assets somehow. And this is how I do it. And, the dividend investors are like, "Oh, I need I need like 5 million to retire." And I'm like, dude, I could do that on 500,000. 1% of 500,000 is 5K a week. And I can live comfortably on that. And in any city on the planet, really. Might not be living a lavish lifestyle on 5K a week in New York City or someplace, but you're not gonna starve either. But so that's kind of my explanation for how much it cost me to learn these lessons and kind of settle into this strategy that is straight up covered calls. It's not the dangerous long options. I'm not putting most of my account at risk for devastating losses in a drawdown. It's just the same downside risk that the buy and hold folks have. All right, so part 2 of the question is, but why do I sell covered calls also against something like a MicroStrategy that I have so much? I'm so bullish that I think this is going to go 5K, 10K, or higher by the end of the next year, based on some multiple of Bitcoin, but also inclusion into like the S&P 500, all kinds of other things are going to end up pouring money into this stock. And the Quant Bros channel has covered that extensively. So I'll leave all of that analysis to them, since I couldn't reproduce it if I tried. So, but why would I risk unlimited upside in something that I think is going to go up like 10x? And it's basically what I was talking about. So I've already decided on my covered call strategy. I need to do something in order to generate money. I got to pay my bills. And so that's a strategy that's been working for me, and it's been generating returns well above the just sitting around and watching the SPY do whatever the hell it's going to do. My returns far exceed the S&P 500. And so I want the best ticker that exists. Why would I trade a stock that's not the best stock? I want it to go up as much as possible every time. And even if I do miss out on some upside, like I got wrecked, I had the 1400 strikes when this went to 1700, and I had to pay like 30 grand to roll those. And while that stings, it almost kind of doesn't matter because now I'm selling covered calls at a higher price. So I'm collecting 1% on a bigger number anyway. And I don't necessarily know that I've recouped all of that money back since it happened. But in the very next week, I sold strikes for like 10 grand on, one contract. So I got 10 of that 30 back in 1 week. So it doesn't really bother me to a certain extent, but there's other ways to mitigate this unlimited upside dilemma as well. And those scary, dirty, dangerous leaps that I was talking about, instead of buying the ones that, like I did in my IRA where I can sell covered calls against, you can also get the cheapies all the way at the top of the options chain. So I went and bought the cheapest ones I could on November 15th, and I bought 3 of them. I paid about a little over 5 grand each for them, and these serve as a little bit of upside protection against me having these covered calls on. So if you can see that the price ripped from, I think I bought these when MicroStrategy was around 1200 or 1400-ish. And they've basically doubled. At one point they were triple when MicroStrategy was at like 17, 18. And the price went over my strikes on one of my, I had 3 of these contracts at that time. I think I had 300 and something shares here. And that's another thing. I have 240 shares, so 40 of those shares are uncovered. And I could, even though I can sell 2 covered calls, if I didn't want to lose them all, I could just sell 1 covered call. There's no, I sell covered calls at every price, every week, on every increment of 100 shares that I can. But you can be surgical with it. You don't have to be a degenerate like I am. But if the price rips to 2 grand, this will probably go to 15 or 20,000. And if I miss out on, what are my strikes? 1980? Yeah. So if it goes to 2,200 and I miss out on 20 grand on each of these, well, then these leaps will probably be worth 20 grand each. And if I want to sell these to mitigate this going over my strikes, then I can do that. I'm making about 1,500 a week on each of these, so it would take almost 10 weeks in order to be able to afford another one of these. But I'm also leveraged, this is a margin account, so when MicroStrategy was down to 1,200, I had very little buying power. I was very close to a margin call a couple of times. And so that's another thing, another consideration. Some people trade in straight cash accounts, and that's the safest thing to do. And so, definitely do that if you don't like, if you like to be able to sleep well at night. I've been doing this long enough, and I'm comfortable with this level of risk. Plus, I have some liquid, access to more money if I need to. I've got a HELOC on the house, so I can instantly just go to that and transfer the equity from the house over here to avoid a margin call if I really had to do that. But that's kind of like an case of emergency break glass kind of scenario. Yeah, so that's why I sell covered calls in MicroStrategy, even though I could be sacrificing a bunch of upside here. I've already chosen my strategy. I'm going to sell covered calls to generate yield. So what stock am I going to pick? I'm going to pick the ones I believe in. It's going to be MicroStrategy. It's going to be Tesla. And I don't love the miners as much as I do MicroStrategy, but tastytrade was not terribly happy about the concentration risk when I had 90% of my portfolio margined and levered to bejesus in MicroStrategy. So I threw the algorithm a bone a little bit, but it's also nice to be able to sell these as an example for the videos for any, for people who don't want to trade MicroStrategy. They prefer to maybe take less risk, or just hodl their MicroStrategy, but they want to screw around with the strategy and do that on some cheaper stocks. So that's a smart thing. The other surgical thing that somebody can do, especially with a MicroStrategy, so this is Market Chameleon. If you go to the implied volatility chart, you can see that this is MicroStrategy's implied volatility over time. This is over the past year. And so implied volatility is a mean reverting stat. Sometimes it'll go up, sometimes it'll go down. And a lot of times implied volatility will go up before earnings and then collapse. It's called IV crush. But if I wanted to be a little bit more strategic and surgical with selling covered calls and MicroStrategy, then while implied volatility is just kind of doing nothing, then maybe I do nothing. And then right here, March 4th happened, and holy crap, MicroStrategy went from like 600 a share to 1,200 or 1,500 or something. So boom, March 4th. Now implied volatility is high. That means option prices are high. That means this moment right here is when you can sell options for the most amount of money. So let's look at the chart on March 4th. If you're watching the implied volatility, and then on March 4th, you saw the price, you were hodling, it was 500 a share, and now the price is, what, 1,300 a share? Tapped out at 1,400 a share. So you collected two, almost 3 extra money, and then maybe here, you're like, oh, okay, well, I'll sell covered calls when the options prices are the most, and, is it possible when this was at 1,400, I would have probably sold like the 1,700 strikes at that point. So what is a week from here is what, March 11th? So March 11th, the price was, 1,700. So that would have worked out. And then when the price is 1,700, I probably would have sold the 2K. Oh, and look at that. That's where it would have topped out. So I do this mechanically. I sell covered calls in practically any environment, and maybe that's something that I need to perfect. Maybe I could do something like this where I combine a little bit of hodl with a little bit of being strategic with watching the implied volatility chart. And then as implied volatility starts reverting to the mean, if the options premium starts to dry up, then maybe this is when you stop selling covered calls again. And so then you stop selling covered calls, and maybe you don't make money as it's on its way down, but then you watch it go down to 1,000. And then when it rockets up here, what is this? May 20th? Let's see. On May 20th, implied volatility, kind of went up on 17 May, 20 May. So maybe you start selling again here, which would correlate with, not missing out on the upside from 1K to 1,700, and start selling covered calls again right around here. Now, this doesn't mean, and it does look like it's kind of consolidating here. So, this has got to break up or down eventually. So is this going to break to 25K and you're selling like the 2,300 strikes and you miss out on 20 grand? That's completely possible. And history shows that if it can happen to me, it can happen to you. So again, And I sell the weeklies too, so I don't really give myself a long DTE, days to expiration, to be right. A lot of times Tasty Trade, they're like, we go to 45 days because we want to give ourselves time to be right. And that does make some sense here, because like when I had the 1400 strikes, when I went to 1700, if I had another 45 days to wait when it went to 1700 right here, right? If I had another 3 weeks, so this is March 14th, so another 2 weeks to get to the end of the month. So what am I looking at, like April 7th? So April 7th, the price was 17 again, but as low as 14. I can't see this candle very well. But that extra time can capture the ups and the downs a little bit better, whereas I'm hunting the big premium, the big weekly premiums. So that's another option, is choosing a longer time frame, so that if you do sell a covered call here and you're like, oh geez, March, 45 days are going to get you to mid-April, so you can just grit your teeth through here, and then the price of the option comes back down to basically where you were a month and a half before, and maybe you avoid having to pay to roll in that scenario. But I'm so used to the wheel strategy, which is selling cash secured puts until you're assigned, and then selling covered calls until they exercise on you and call your shares away. I'm so used to that, trading in and out of the shares, that this, paying $30K 1 week to roll, I don't want to act too nonchalant about it, but it's just kind of par for the course, and it doesn't really bother me that much. So that's why I sell covered calls. That's why I use this strategy. It reduces cost basis. Yes, it sacrifices unlimited upside, but once I turn this into a compound interest machine, I don't need unlimited upside. 67% returns a year, regardless of whether the price moves or not. I am good to go with that. And any upside is just gravy. Like I don't need any upside. All the upside is just a cherry on top for me. But then why do I sell MicroStrategy? Because it's the best asset. It's the best stock in the stock market. So if I think this is the best strategy for me, I still want to use the best asset. I'm not going to avoid selling against MicroStrategy just because I might get some heartburn later that I have shares called away. I still want to capture as much upside as I possibly can while I'm implementing the strategy that I've chosen. So I'm not going to hamstring myself by selling covered calls in something that I don't believe in just to avoid missing out on unlimited upside. Like, that doesn't make any sense. I want this price of the stock to go to eclipse my strikes every week. Eventually, if it prices me out, then it prices me out. I'll sell some more Portman's covered calls in it, like I did in my IRA. For some people, I guess, if you're just starting out, you maybe don't want to risk missing out on this. This might be a life-changing opportunity. So buy and hold for the next 18 months might make the most sense. But the account size that I've grown to this point, I don't really need to 10x my money in order to be set for life. So um, everyone's everyone's circumstances are a little different. If my account basically just doubles from here, there's no way I clock in. That's not going to happen. So my quit timer is running, and I'm definitely going to make a post about that. Maybe I'll just, I wonder if I should do that. It's funny. Punter Jeff, he posts every day like how many companies MicroStrategy went up or down against as far as market cap, and also updates their, however many days that they qualified for inclusion in the S&P 500. And maybe I'll have a timer like that where every day I just I just post my quit timer. But anyway, it feels good to be able to generate income. Like right now, if they laid me off, I wouldn't starve. I could probably be fine and maintain my current lifestyle. So that's what I mean. For me, I don't really need MicroStrategy to 10x. I could kind of get by right now at what it is. And if MicroStrategy just doubles over the next year and a half, I will never work again. So good times. Looking forward to the future, and hopefully some of the painful lessons that I learned, painful and expensive lessons that I learned, will help folks not repeat those mistakes. And I guess it would be a good time. I mean, my account's not big enough for people to like impersonate me yet. I guess I'll feel like I have arrived when they start, the bots start copying my frickin' profile pic or whatever. But I might as well just say it now. If anybody is in your DMs asking for money, that damn sure isn't me. I can't imagine a situation where I'll ever ask anyone for money. I am going to try to build this XUp account, and hopefully they'll monetize me or whatever, or maybe I'll do a subscription or whatnot. And I don't know if I want to do eventually I'd like to not do YouTube at all. But it's kind of cool when I watch some people getting super chats and all that good shit. But I'm not sure that I even ever want to do that. But getting monetized eventually one day would be cool. But I'm never going to have like, okay, other than a subscription, I'm not going to be like selling people anything. So if I slide into your DMs, it's just to ask how you're doing or to chit chat about options, and I'm never going to ever ask anybody for money. So if anybody is, you can definitely report the shit out of them, because it ain't me. But all right, hopefully this has been valuable, and I hope everybody's accounts our number go up, and don't be eggheading shit and trying to get too smart for your own good, because this is the type of shit that can happen once you get a little too comfortable and start thinking your shit don't stink. So all right, I'll leave it there. Be good, y'all.